Hi, this is Bob McGee, Chief Investment Strategist at WesBanco, with a June market update. Over the past month, U.S. equities have remained resilient, with the Standard & Poor's 500 index holding near record levels, despite elevated volatility. Technology and artificial intelligence-linked sectors continue to outperform, while more defensive sectors lagged as investors rotated towards growth. International markets were more mixed, reflecting greater sensitivity to energy prices and geopolitical uncertainty. Turning to fixed income, bond markets faced renewed pressure as Treasury yields moved higher following stronger than expected economic data. The labor market has shown signs of stabilization in recent months. The unemployment rate has averaged 4.3% this year, and underlying job growth is running at or above the estimated break-even pace needed to keep unemployment steady. Overall, the recent employment report was solid. Headline payrolls exceeded expectations, and prior months were revised meaningfully higher, which were well above 6- and 12-month averages, indicating a re-acceleration in hiring. Importantly, job growth is no longer concentrated solely in sectors like healthcare and social assistance. More cyclically sensitive sectors like manufacturing, construction, and leisure and hospitality are now contributing as well. Market participants increasingly believe the Federal Reserve's narrative is beginning to shift. The question is no longer when the Fed will cut rates, but whether the next move is even a cut at all. Treasury yields across the curve moved sharply higher following the payroll report. Futures markets now fully price in the possibility of a rate hike by year end. At a minimum, this suggests the Federal Open Market Committee, or FOMC for short, may remove its easing bias at the June 17th meeting, potentially adopting a more hawkish tone given the signs of labor market re-acceleration. The Consumer Price Index rose 0.5% in May, matching expectations and pushing the annual inflation rate to 4.2%, its fastest pace in 3 years. Energy costs, especially a 7% jump in gasoline, drove most of the increase, while food prices saw only modest gains. We are watching for how the effects of the Iran war could ripple through the economy, spreading inflation pressures beyond the gas pump. Recent tensions involving Iran continue to influence global markets. Energy prices remain sensitive to any escalation, and concerns about supply disruptions have contributed to volatility across commodities, equities, and fixed income. While markets have retraced most of the initial risk-off moves, the situation remains fluid, and energy-driven inflation risks remain a key factor for both investors and policymakers. For more on what this means for you, contact your WesBanco representative.